Hi, I'm Pattu from FinCal. Today, let's talk about indexation benefits that are available for non-equity mutual funds and find out how that actually lowers the effective tax that you have to pay. Non-equity mutual fund refers to any mutual fund that's not an equity mutual fund. That's how the income tax department defines it. As far as the income tax department is concerned, there are only two types of funds: equity funds, those which on average over a financial year invest in minimum of 65% or above of Indian equity including arbitrage. Those are all called equity mutual funds, and any other mutual fund is called a non-equity mutual fund. So as far as the taxation is concerned, whether the mutual fund invests in bonds or it invests in a hybrid of bonds and equity, but it's a debt oriented hybrid fund, or which in the olden days they used to call it as a monthly income plan. Some of them, whether it's a gold fund or gold ETF or international mutual fund or international ETF, all of them are classified by the income tax department as non-equity mutual funds, and these have what is known as the indexation benefit. I'm going to illustrate what this is because they use what is known as a cost inflation index, and the cost inflation index for the current financial year, that is FY 2020-2021, is being released just now a few days ago by the income tax department and by the Ministry of Finance, and we can use that to have a illustration of indexation benefits. Indexation benefits apply to long-term capital gains of non-equity mutual funds, and a long-term capital gain means a gain from your mutual fund unit or ETF unit purchased more than 3 years ago. So you must, if you redeem the unit that was purchased more than 3 years ago, then your gain, if you have some, will be subject to what is known as taxation with indexation, long-term capital gains taxation with indexation. So let's get to an example. I still can't scroll because I need a mouse, so I have to get rid of my face for now, get to the full article. I need to get a Bluetooth mouse, otherwise this won't work. So the cost inflation index in the year 2020-2021 is 301. So let's assume that you made a purchase of a non-equity fund in May 2017, and in the year of purchase the cost inflation index was 272. So let's take the example of FT US feeder fund. This is an international equity fund, but it's classified as a non-equity fund for the purposes of taxation. Over the last 3 years, it has given about 22%. And if you had invested 10,000 rupees in mid 2017, it would now be worth about 18,000 rupees. So that's an absolute capital gain of 8,000 rupees. However, the tax that you pay will not be on the 8,000 rupees. So what we do is to inflate the purchase price by taking into account the inflation. So what we ask is the cost inflation index. So what we ask is, when we invested 10,000 rupees, the cost inflation index was 272. But if 10,000 corresponds to 272, what amount would correspond to 301, or that is the current cost inflation index? So the inflation adjusted purchase price is equal to the purchase price 10,000 into the cost inflation index in the year of redemption, that's the current year, that is 301, divided by the cost inflation index in the year of purchase, which is 272. So 10,000 rupees because of inflation has now been increased to 11,066. So that's the inflation adjusted purchase price. So the actual capital gain is 8,000 minus 10,000, which is 18,000 minus 10,000, which is 8,000. But the inflation adjusted capital gain or the indexed capital gain is 18,000 minus the inflation adjusted purchase price, which is 11,066. So this is 6,934. We pay 20% tax on this 6,934 plus 10% surcharge plus 4% cess, which is an effective tax rate of 22.88%, and 22.88% on 6,934 comes out to be 1,587. So the actual post-tax capital gain is 8,000 minus the tax paid of 1,587 comes to 6,413 rupees. This means the effective annualized gain. So if you invested 10,000 rupees, 10,000 rupees became 10,604. 10,000 rupees became 16,413, and that means the effective post-tax annualized return is 18% by taking into account indexation, and that is a very decent profit indeed. But don't go rush out to buy international mutual funds because they're risky, and also you need to wait for 3 years before you employ this indexation benefit. You got to be careful about that, because if you are investing in a portfolio for diversification basis, then you will have to systematically rebalance, or you have to employ a trigger rebalancing. Definitely over the 3 years, you must have had at least 1 or 2 trigger rebalancing because of the way the US markets moved up, and because of that you have to forget about the indexation benefit and rebalance the portfolio, because risk management is more important than taxation. So this, when you are using it as part of a portfolio for diversification and a small exposure to US equity, however way you look at it, you cannot always be employing this indexation benefit. So that's something that you need to keep in mind. The same logic applies to gold as well. In gold also you cannot employ this indexation benefit. So let me just, okay, now I'm able to scroll. Okay, now I have to use 2 fingers to do this. Okay, I found that out. So in the case of gold, the last 3-year returns were 16%, and if you use the same indexation benefit, the post-tax return comes out to be 13.4%. Even in the case of debt funds, if you assume a 6% kind of pre-tax liquid fund kind of return, it would be 5.4% after post-tax after 3 years. So when will this indexation benefits work? It will work for medium-term goals, that is above 3 years but below 10 years, where the equity amount will be less but the debt amount will be more. Then indexation benefits will play a role. Then you don't have to worry too much about rebalancing, and most of the time it will be in debt and so on. But in the case of arbitrage funds, it will be a little more tax efficient, because overall there is a 1 lakh tax free limit, and after that the long term capital gains after 1 year is only 10% plus cess. So arbitrage funds naturally will be more tax efficient, but it depends. I mean, it depends on what you want to choose and so on. So my suggestion is people is not to run after guaranteed return or safety of capital too much. Over 2-3 years it's okay, you can have safety of capital, but for 7 years, 8 years and so on, it's okay to invest in something more tax efficient like an arbitrage fund or a debt fund. You can do that. Also, some people, just for fun, they invest in US equity just to satellite portfolio, they want to get some returns. Then indexation benefit will lower the taxation there for them. So that's what I wanted to say in this video. I found out how to do the scrolling with the face on. So I'll catch you again in another video. Bye bye.